Josh, can you hear me?
Yep. Yeah, we can hear you great.
Great. Well, great. I want to say welcome to everybody and everybody that's on the webinar. Thank you for joining this conversation tonight. My name is Darcy Perkins. I'm the Assistant Director here at the ICELab. The ICELab is a co-working space on campus at Colorado Western University, for those of you who aren't in this room. David Assad, the director of the ICELab, and myself, we manage the co-working space, but we also do a lot of work on economic development initiatives in the county of Gunnison. So we have a few more people joining us. We invited, I want to introduce Dennis Lankus. Dennis is a 20-year serial entrepreneur who has started 7 companies. He is currently the chief, sorry, I want to get his title right, visionary officer at Proximity. Proximity is a co-working platform which has over 500 co-working spaces in the United States, Canada, Australia, and New Zealand, and over 60,000 co-workers in its spaces. He is located in Montrose. Proximity is a Western Slope business. Dennis's business, Proximity, is also the first, as far as we know, and according to OEDIT, the first Colorado business to secure Opportunity Zone funding. So that is not a real estate investment. So we asked Dennis to come tonight to talk to us about how he did that. How did his business become an Opportunity Zone invested business? And as a result, he's invited experts from the state and from the country here to talk about Opportunity Zones, what they mean, and how we might be able to use them better. So with that, I'm gonna hand it over to Dennis.
Hi, everybody. Thank you for having me here. The only thing that I'll adjust to what Darcy said is I am one of 7 co-founders in Proximity, so it's actually not my company. Our CEO is this lovely gentleman on this TV screen right here, and so he's the one that's actually going to be talking to you about how Proximity took investment as an OZB. But as Darcy said, we asked some other individuals here with us. So Chris Montgomery, who's actually sitting here in the back, is a Rice graduate of economics and the managing partner at 4 Points Funding, which is an active opportunity fund focused on rural Colorado and like communities. And you also have 7 years of investment in real estate in Colorado right now, if I've got that correct. Is that right? Jana, Jana, can you say hello real quick so we can see on the screen?
Hi, everyone.
So Jana is a Stanford graduate with a BA in public policy in the state and is the state of Colorado's Opportunity Zone program director for the Colorado Office of Economic Development and International Trade. She works to really work with the rest of the state to try to help educate. So she's a huge asset to have here with us tonight. So Jana, thank you for being here with us.
Yeah, thank you for having me, and thank you to everyone for coming out.
And then we have with us Jeff Goldman. Jeff, can you say hi real quick?
Greetings all. It's nice to be on.
Jeff, thanks for joining us from Denver. Jeff is University of Chicago Law and a shareholder with the Polsinelli law firm. He has 25 years of experience in taxation of business enterprises, including corporate partnership taxation, state and local tax, international tax, and tax controversy. Jeff is also concentrating right now on providing tax advice and compliance relating to the Opportunity Zone programs. Jeff, thanks for being here with us.
Great to be here.
And then last but not least, well, maybe least, Josh, can you say hello again?
I think least is fair, and actually I like coming after the 2 more intelligent people. So hello, thanks for showing up for this. This is fun.
So Josh is a serial entrepreneur as well. He's the CEO and co-founder of Proximity, a network of connected co-working spaces and a software platform that connects over 60,000 remote workers around the world. So Josh is currently the head of Proximity and has accepted its first investment as an OZB. So that is our panel that's with us today. We've got an agenda here that I've been asked to share with you, and then I get to get out of the way. We're going to start with Jeff Goldman. He's going to talk about the legal tax overview, and Jana's going to come in right behind him with the overview of the OZ program as a whole. Josh is going to come in to talk about taking an investment as a business and what that means to be an OZB. And then Chris is going to close it out with us for a 4 points funding and OZ fund investment overview. Is everybody comfortable with that agenda? And then after that, we're going to have a opportunity for Q&A. So obviously the people that are here with us in person, I have a mic. The panel can hear you. I'll hand it off to you if you have questions after that. If you are online and watching, there should be a button down at the bottom that says Q&A. If you will submit your questions, we have David here with us from ICELab that is watching for your questions, and he will flag me down and share your questions with the panel and the audience here. So with that being said, I am going to get out of the way, and Jeff, I believe you are up.
Thank you. And again, I'm Jeff Goldman. I'm glad to talk to everybody. I hope you can see our Polsinelli spiel, which is a pretty general PowerPoint presentation about how the program works and some later developments and how it can work for operating businesses. The first quick is that I am a shareholder with the law firm of Polsinelli, which has 900 lawyers around the country. We go through the Midwest with big offices in Chicago, Kansas City, St. Louis, Denver, Dallas, and also some on the coast. And I do lead the tax side of our Opportunity Zone program, which is, I think, probably one of the largest around. We have about 30 people in what I call the Borg, because we keep absorbing more people into the program as deals go on. I thought what I would do is give a short introduction to the how we got to where we are, and then leave it to Jana to say a little more about the specifics of the program. The beginnings of the program started with, and just as an aside, it seems that my computer no longer controls this this PowerPoint, so I'm going to just stop it and not worry about it. If anybody is interested, Darcy has copies of it, and please just talk to her, and I'm sure she'd be happy to send it out. So the genesis of the program was started in 2015 when Senators Tim Scott of South Carolina and Cory Gardner of New Jersey, Republican, Democrat, came up with this idea to try to circulate capital gains into lower income areas. And it was adopted as part of the 2017 tax bill. As a tax lawyer, I can say that it was not only the only part that had bipartisan support, but it was the only one part of the program that was really any good. I won't repeat that, but this particular area does have some really positive aspects to it, especially given what they're trying to do. And the idea was to tap into something like $6 trillion of capital gain that had just built up into assets. So lots of people had appreciated assets, and what the idea was to encourage them to sell and to invest those gains in these opportunity zones. I'll leave it to Janet to describe the zones a little bit better than I can, but there are something like 8,700 of them around the country right now. And they're not going to change pending additional legislation.
Hey, Jeff, this is David. Please. This is David at the ICELab. We're going to flip the slides for you, so if you can just tell us which slide we should be on.
Cool. That one's okay. I'm sorry.
Okay. Whenever you flip, just say next slide, and I'll flip them for you.
I can do that.
Okay.
Thank you. I guess next slide, please, then. Cool. This one repeats that it was the two senators that really were the leading principles behind the program, and we do get a lot of questions as to what is going to happen to it. Is it possible that this program could be wiped out? There have been a couple of bills introduced because of some bad publicity about some folks taking sort of extra advantage of the program. But given that it does have such bipartisan support, and at least from my experience, a significant amount of the investment is going where it's supposed to go. There might be some minor changes to it and some additional reporting requirements, but at least the general consensus is that it's pretty solid. Next slide, please. And why don't we go to the one right after that? And I'll say real quickly that the Opportunity Zone program gives three tax benefits to people who invest. One is if you invest your capital gains into an opportunity fund, which does what it's supposed to according to the law and the regulations, you can avoid paying tax on that capital gain for up to now 7 years, up to December 31st, 2026. If you hold that interest in the fund long enough, you can get a discount. So you put $100,000 in an opportunity fund, you do have to pay tax on it, recognized in 2026. But if you invest by December 31st of this year, you'll get a 15% discount. If you do not invest by then, but you invest sometime within the next 2 years or before the end of 2021, you'll get 10% discount. Those are nice, fun benefits, not thrilling. The real fun is that if you hold this investment for 10 years, you can sell it and have no tax at all on the gain. So if somebody had put Microsoft in an opportunity zone and done the right thing, all the billions would be tax-free. Bill Gates could have realized those before he dies. So those are the basic benefits. And now let me just say a couple words about how the program has gone from a tax perspective. Really nothing much happened for the first 8 months of the program because there was a lot of uncertainty. In October of 2018, the first round of regulations came out, and that were mostly geared toward real estate investments. And as I think I heard, most of the investments and most of the deals we've done have been real estate deals. We've closed, 40 deals, maybe more, since that first round of regs came out. But it was still difficult to know what to do with operating companies. Then the second round came out in April of 2018. And that really told us what we needed to know for operating companies. And it is still behind real estate. I would say still of all the deals we've closed, probably, $1.2 billion in capital raised, maybe 90% has been for real estate. But that's actually pretty good considering how late a start operating companies got, and they're actually starting to catch up. And so for the most part, with respect to the investment timing rules, which are complicated, with respect to qualifying your business, with respect to meeting all of the other requirements, we pretty much know what to do. And the last thing I'll say before turning it over is that the one thing that I will say that we know for sure is that the structure is going to be, this question always comes up, so I'll answer it now. the investment of capital gains is going to go into something called an opportunity fund, which is just a company that meets the requirements and has a few magic words. You can have your own fund. It doesn't have to be a fund like you hear about private equity. Those opportunity funds will not own the business directly. They will own it through a lower tier entity called a Qualified Opportunity Zone Business, or QOZB. And virtually all of the funds we're seeing now, all of the investments, are this two-tiered structure. And I suppose it's not because we really like the acronyms, but really that is the way that it will go. I really look forward to hearing from my colleagues and answering questions and having a discussion. But for now, I'll turn it back over. Thanks so much.
Appreciate that. Jana, I think you tried to ask me a question. I'm actually not in the chat. So if you ask David, then he can share that with me.
Yeah, no worries. Yeah, before I started, I was just wondering if you could help us get a sense of the room, what folks in the room are most interested in terms of, we have investors, entrepreneurs, community leaders, real estate folks.
Fantastic. I would love to do that. I'm sorry you can't. Actually, you should be able to see everybody from the other camera. So yeah, I'll ask them to raise their hand and you guys will be able to get a feel for the room.
Great.
So I'm going to go through those questions again. I think I caught them quick fire, but if you are interested in opportunity zones from a real estate standpoint, can you raise your hand? If you're interested from an investment standpoint, can you raise your hand? I love how the investors always raise their hand like this. What was the other one, Jana, that I missed? An OZB, if you're a business looking to take investment from an opportunity zone fund, can you raise your hand? So we got a few in the back too that are sitting behind the camera, Jana, so you didn't get to see them. Was there another question that I missed?
No, unless someone else in the room wants to speak up and make sure their perspective is noted if they didn't get to raise their hand.
General community and economic development. Okay.
Great.
So if you saw the raise of hands, it's a definite mix.
Great. Yeah, well, thank you. Well, then I'll jump in, and that's helpful to hear. Can everyone see my?
Yes, we can.
Great. Can you see in slideshow mode? So as Dennis mentioned, my name is Jana Persky. I'm the state's Opportunity Zone Program Director. I've been working on this for basically our state has put resources into this since the incentive was created at the end of 2017, and I've been working on it full time for almost 18 months now. So just wanted to start with a map of Colorado's opportunity zones. You can, if you haven't seen this before, you can go to www.choosecolorado.com/OZ. You can actually put in a particular address and see exactly where they are. We're pretty excited about the mix of zones we have across the state. About 60% of them are in the rural areas. And for folks in Gunnison specifically, just downtown Gunnison is the one zone in, I think, all of Gunnison County. But there's also the tracts in and around Montrose, Grand Junction, other parts of the Western Slope. So if you're interested in learning more where those boundaries are, like I said, choosecolorado.com/OZ. And so we think of our program as designed to position Colorado as a leading destination for capital investment and make sure that that investment is being used to benefit distressed communities. As Jeff pointed out, this is really just an incentive. So there's not really any need for government involvement. This is where I kind of give up my game and say, you don't actually have to come to me for any approvals or certifications or anything like that. Now that the zones are designated, the official sort of programmatic role of government is taken out. But we really thought that this would be a tremendous opportunity, for lack of a better word, to help bring capital into the real estate and the business opportunities, particularly in rural Colorado, but really across the state. And so we've been working, these are the 4 pillars of our program. The first, as I already mentioned, is the nomination process, which is already completed. This is also where try and head off any questions by saying that unfortunately we cannot change any of the zones. They're fully designated by U.S. Treasury, and so it requires an act of Congress to reopen that designation window, and I'm not really counting on that happening anytime soon. The second piece of our work is education. That's why we're really excited to be here. What I think is really exciting about the Opportunity Zone incentive is that it brings together a lot of different stakeholders. The groups all in the room, like the economic development leaders, investors, entrepreneurs, real estate folks, really coming together and figuring out how we can use private capital to spur business development, spur economic development, and spur community development. Really excited to be speaking to you all today, and hoping to, happy to follow up or answer any questions or connect to resources. The third piece that we've been spending probably the bulk of our time on is this community support piece, really helping communities think about how they can bring private capital into their community and economic development strategies. And so that's in many communities taken the form of the prospectus. And as Jeff kind of talked about, initially a lot of that was around real estate projects, and there's some really exciting opportunities there for, housing projects, downtown revitalization, things like that. But one of the things we're looking into now that the guidance is more clear, is how we can bring more businesses into that. Because, buildings on their own don't necessarily promote economic and community development. It's the jobs and the people that fill them. And so we're continuing to work with communities to think about what are the types of incentives that can be offered, what are the different ways to attract private capital and support business growth in their community. And then the final piece is investment facilitation, helping capital and projects find each other. And so we've done this through with a tech platform, which I'll talk about shortly, the Co-Invest site, and then also in-person events. So I'll give another plug too. On December 12th, we're having another Opportunity Zone event in Grand Junction at Colorado Mesa University with many of the same panelists giving their updates, and then also a couple others and some folks from the Western Slope and Western Slope communities pitching their projects and trying to find investment. And so I won't steal too much of Chris's thunder, but I think a couple of the things that are important in how investors think about Opportunity Zone investment is that, the tax incentives and the tax bumps are nice, but in general, people are still seeking, market rate returns. And we really have started to see the incentive as de-risking investments, particularly in, scary areas like the rural Colorado and the Western Slope that don't have quite the same established track record that maybe Denver or Boulder do. And so, it still has to be a good project, but this incentive can help crystallize some of the returns and de-risk the project. Based on the structure of the incentive, as Jeff laid out, many times it's all about long-term investment. So a project that needs to be well suited for that 10-year hold is probably best suited for this incentive. In many cases, investors are focusing project by project. We're starting to see more of these multi-asset funds come up, but because of some of the timing constraints, that investors either kind of are thinking about, if they either have their capital gains and are going out and searching for the project or the company that they're going to invest in immediately, or they have the project or the company in mind, and then they go back and find investors who have realized capital gains within the timeline. But it can be difficult, particularly in areas that are not as well known and not as publicized. Investors are working hard to find these viable projects. And so in many cases, it's up to businesses and projects to do some of the outreach. And then, I think excited that we're talking about the full spectrum, because as Jeff mentioned, the business investments, the guidance was a little bit later coming out. And so that market is not quite as developed and not as mature and well known as the real estate market. But we're excited that Proximity is one of the companies that's figured it out, and there's also some other companies and funds across the country that are starting to really figure out a model that works, not for all companies, but in the particular case in which it does. And so this is a flow chart. I know it can be a little bit complicated, but I think helpful thinking through the conditions for if you're a business. And again, the main benefit for businesses is easier access to equity capital. So in general, the incentive doesn't accrue directly to the business, it accrues to the investors, but because the investors are investing in a qualified opportunity zone business. So just to kind of briefly run through this, on the far left side is just there's the qualifications of, can your business even be an opportunity zone? The first question is, are you a SIN business? This is kind of the weird list of liquor stores, golf courses, tanning salons, things like that. But if you're one of those, unfortunately, you can't directly qualify as an opportunity zone business. Second question is 70% of your business's tangible property located within the opportunity zone. And then below that are the 3 safe harbors where you only need to meet one of these. But either the 50% of your revenues, 50% of your employee hours, or a significant portion of your management or operations, one of those 3 things needs to be true in order for your business to qualify as an opportunity zone business. And then, presuming you do meet those qualifications, you're not a SIN business, 70% of the tangible property is within an opportunity zone, and you meet one of those 3 safe harbors, then it's worth thinking about, is the opportunity zone right for you? And likely for this audience, I'm not telling you things you don't know, but it is an equity investment where you're potentially giving up portions of your ownership. And then, you need to be looking to grow in the next 10 years while remaining in qualification. So, as the disclaimer says, not legal advice. If you're really thinking about this, go talk to Jeff and work out if you do qualify. But I think it's helpful just to, at least orient yourselves to, could your business qualify? And then is opportunity zone incentive the right one for you? And so just a couple resources that the state has. As I mentioned, we have our co-invest site. The URL is on the screen here, but investors, projects, businesses seeking funding can all go on there and upload your information and find, search and filter for like-minded folks or partners. We're also having our pitch event, as I mentioned, December 12th in Grand Junction is our next one. The application, I'll send it over to David and Darcy, and I think it can also be found at choosecolorado.com/OZ. That's open for a couple more days if you're interested in pitching or attending that event. And then the final piece is that we have technical support grants available. They have to be applied for by a local, either elected leader or nonprofit or economic development organization, but they can be used for a private project. So if you're trying to think about how your business could potentially, or your fund could potentially take advantage of opportunity zone funding, and you need a little bit of, time with Jeff, or you need some accounting help, or you need a feasibility study or something like that, we can help fund some of that, because we recognize that this is a new market, and so trying to eliminate some of the friction there. These are, when we send this out, there's just a few more slides there that basically copy Jeff and Polsinelli's slides of explaining the incentive. But really just wanted to say, we're excited about the potential for this incentive to help bring capital into, all over Colorado, but particularly rural Colorado, and particularly the opportunity zones on the Western Slope. And so if there's anything that we can do to help in terms of connecting to resources, providing information, anything like that, my email and phone number can be found here. Thank you.
Jana, thank you a lot. I really appreciate that. And I can't understate the resource that Jana has been to people. So Jana, thanks for being here, and thanks for continuing to share across the state. Really appreciate all the time and efforts that you're putting into it.
Yeah, thank you.
Josh, I believe that means you're up, brother. And real quick before Josh gets started, Chris, are you going to supply maybe some other resources for funds, or should I just not mention any other fund besides yours?
Nice, Chris.
So if you guys have questions, I think Darcy and David will have some more resources, but really want to leave a lot of that attention for Chris. I imagine that might be some of the questions that might have gotten missed with Jana's as well. So before we go on, are there any questions in the Q&A? Is everybody cool with being patient and waiting for 2 more presentations before we get into questions, or are there pressing questions that you feel like you want to ask right now? No? Good. Okay, Josh, you're up.
Okay. I always like to start with, I really want Janet to actually go through the sin businesses again, because some of them just make me crack up laughing that they would be included, but maybe we'll do that after this.
No tanning salons.
No tanning salons, please God, no tanning salon. Anyways, thank you guys. Again, Josh Freed from Proximity Space. And I've actually had the pleasure of talking with both Jeff and Jennifer a couple of these now. And I love the Q&A with these guys. So seriously, be thinking about your questions, because I still go to them with questions, and it is such a pleasure to actually get some deep insight into this. And especially if you can get Jeff to really think about something and have to sit there for a minute, it's really fun what he comes up with. So I love it. So proximity, and my role tonight is really just to give an example. I know some of you in the room, I think I saw Sam's in there for the room. So you guys have a pretty cool startup that's going on there with Campfire Ranch. I think I saw the side of his face. But I just want to describe what proximity is real quick, and then how Opportunity Zone worked for us. And what I think about it. I've had to come up to speed pretty quick over the last, say, 8 months to get ready for this. So let's see. So proximity, just as a real quick highlight as far as what it is we do: software and hardware to manage co-working spaces and flex spaces. Like I said in the beginning, we work with a lot of spaces throughout the country and in 5 other countries. We run both independent space kind of backbone as well as multi-space. You also have companies like Office Depot, and their pivot into flex co-working is on our back. And it's a really just a very large network of digital nomads, remote workers, and just this pivot of remote work shifting within our workforce. We also do things like run our School of Co-working and community calls, where we're connecting people and places and managers. And that is actually the largest group of operators and managers in the world, 1,600 people that join us in those community calls and schools. 60,000 co-working space members are active within that network, and we actually own and operate 3 spaces as well. So just that's kind of about proximity and just kind of the understanding of what it is we do. Even the space that you're in right now is one of the spaces that utilizes our backbone as well too. So what made proximity qualified within Opportunity Zones? First off, 80% of our staff and 75% of our salaries are based in Montrose and Grand Junction in spaces that are in designated Opportunity Zones. These are co-working spaces that are leased, that were in areas that were needing development anyways, and it would quite by happenstance that they ended up being within the Opportunity Zones when that regulation passed down. Because of the structure of our company, the vast majority of all the tangible assets were accumulated by the corporation post-2017, which kept them into a qualified status. The vast majority of our soft costs and our tangibles are within computers, and we're a software company, so a lot of it's just it's all the MacBooks and it's all the desks, and that was all acquired by the corporation post-2017. And then when this regulation came out, and when this guidance came out in April, it was also, we were in the middle of a open round, so we had assets available to be purchased. I'll pause there, and there's one thing that comes up when I get these questions quite a bit, so we'll get that out of the way too, is those equity that is going to be sold off, which is very common for startups to be selling equity. Just something to note for anybody that's looking to raise this way: these need to be original issuance shares. So this isn't a founder selling part of the company to another investor that already owned. They have to be coming as original issuance from the company. So that has tripped up some companies that thought they were going to be able to maybe partially exit through this investment, and that's really not a great qualification for it. And then the last thing that is probably an ongoing, I think I actually am due for another call with Jeff here pretty soon, is the kind of research around the rules, asset testing rules, continued compliance. There is this new burden, if you want to call it that, of responsibility for an Opportunity Zone business to keep and report back, to keep the funds that are investing, either an individual that's doing it through a fund or an actual fund, to keep the qualifications known and in place. So that's something that definitely changes with this type of capital. And just something that you must be aware of, that it's not quite as simple as some of the other capital sources, but it is very achievable, especially with good counsel. And then specifics, of what we've taken so far, we've gotten common equity, and then that common equity has been converted into preferred equity. And then some things to think about, like qualifications. We've had to come up with a lot of qualification kind of FAQ and checklist, mainly because, like Jeff had pointed out, this program is evolving. It had a later start than the real estate side did. So it's kind of still picking up steam, which means a lot of the phone calls that we will get from prospective investors still require quite a bit of education on our side, as well as steering them towards good counsel, just about how does this investment work? What is the difference between it? For us, especially as a software company, there is this inherent conversation around like, okay, well, what happens if you guys don't go 10 years? What happens if there's some sort of liquidation, some sort of exit? What happens with this capital? And you kind of have to start going through the mechanisms that are plausible with this type of capital investment. There is a continued compliance and qualification process. The companies need to realize if you're taking on this capital, you're going to have kind of a long tail responsibility of making sure that your initial safe harbor qualifications remain in place, that you continue to stay qualified. And that can be tricky when you're talking about, let's say your company really explodes and going like you want it to be, but all of a sudden you have to hire a lot of contractors that are out of the area, or call centers, or you end up having to relocate the business. These are all things that you have this new long tail responsibility of the qualifications of the business going forward. And that continued reporting and compliance, because the last thing you want to see happen is inadvertently losing that qualification and triggering the next thing, which is clawback provisions. Something that needs to be put in place, or should be, at least it's a really good time to do it, is put in the ability that what happens if you lose that qualification? What happens to that capital? What is either the fund or the individual need to do in order to take that money back out and redeploy it to keep, like Jana said, to keep the benefit on the investor side versus the company side. It's kind of their qualification that needs to stay in place so that money continues to be on that 10-year horizon. And then there is some fun ones around the acknowledgement of business decisions. There are rules, and I'm going to let Jeff get into this because he blew me away last time we talked about this. There are rules that change when you take this type of funding around, let's say, subsidiary ownership. So oftentimes when a company is expanding, much like Proximity is, there is always going to be the path that maybe there are subsidiaries that need to come underneath that company. While it's doable, it is not as straightforward as you would think. Also, if that company is looking to go out and acquire other companies or pieces of other companies, those rules have now changed as well too. So it does shift your business structure and does require quite a bit of thought. And then the other thing that, as far as for the company that we realized, the kind of that connection announcement, that kind of cheerleader for these funds, and that's why you have these great people on this call, is, we still are so early into this, and we're seeing a lot of activity in the tail end of this year, but really next year it's going to get pretty interesting. But getting those acknowledgments out there that this is possible, there are projects in your community right now that can attract the capital because they were good projects to begin with. And this is a little bit of a sweetener onto the investor side to say, hey, instead of looking at your more established markets, start looking at some of these other zones that could be a little more advantageous to your investment kind of portfolio and how you've handled your taxes, but also really impactful to your community. These projects tend to be very impactful on things like job growth and sustainability of communities. So it's really a nice set of regulations. I think it's the last thing that I'd probably add. I think that's my last. Yeah, that's not very fun to look at. The last thing I'd probably add is that as a type of capital for business, I like it. I use that because capital can be used in lots of different ways. I like very patient capital that is expecting market returns but has a longer horizon. It acts a lot like impact funds do. And it tends to be much more community oriented impact matters just as much to these investors as market return, because it needs to stay in play for a long time. So it tends to be much more realistic when it comes to business performance. It's not looking for really fast exits at really high valuations. It's looking for something that can sustain through the years. So I think it's a great type of capital. It just comes with some nuances that have to be paid attention to. And I'd be happy to. I'm kind of long-winded. But I'd be happy to answer questions or give color commentary, tell decent jokes. And other than that, I'll let somebody else go.
No color commentary from you yet, Josh. All right. Chris, you are up, sir.
Okay. You guys have a clicker as well, or you want me to just wave at you? Give me a wave. All right. I guess, should I come up here where they can see as well? You'll see yourself on the camera, right? Oh, perfect. Thanks, everybody. It's nice to be here in person and do this. We're huge fans of what Josh and Dennis and the crew are doing at Proximity, so it's great to see a business get some opportunity zone funding as well. So while he's pulling the slides, up and getting that set, we've been doing the road show. Jan and I have been at it seems like 1,000 of these, putting in a lot of windshield time. So it's exciting to be here in Gunnison and do this with you guys. So who we are is 4 Points Funding. As he mentioned, Jeff mentioned a fund. We're a proper opportunity zone fund. Our mission is to invest at scale across Colorado's emerging communities. We do that two ways. We also run something called the West Slope Angels, which is angel investing in startups. And then we have an opportunity zone fund. So I'm here just to talk about the opportunity zone piece of it, which for us is primarily focused on real estate or place-based businesses. So this part of it is not about startups for me. It's more about the real estate. We'll jump into that. So if you could, I've got quite a few slides. I won't talk through everything on the slide because that would take too long. Happy to share this slide deck or our proper investor slide deck with anybody that would like to see it. It gets back to the vision of the opportunity zones really meshing with what we were already doing. It's to serve investors that are taking advantage of the opportunity zone benefit. And for us, that's investing specifically across Colorado zones outside the Denver and Boulder area. So we're a rural focused fund. We're based in Steamboat Springs, so we kind of live and breathe rural Colorado. We're here in Gunnison tonight because a lot of rural Colorado business is done. It's done face to face. So we want to be here and see you guys and talk both about how we invest and how we fundraise as well. And an impactful community transformation down there at the end. This only makes sense in communities. For us, I think Janice said it, one more vacant building or one more building doesn't really move the needle. So this is investing alongside of the right kind of deals to have the impact that community needs. And in rural Colorado, these communities are really different. Gunnison has very different needs than Delta versus Meeker versus Craig versus Aspen. There's no opportunity zones there, but there's a wide range of communities. You can go on to the next one here. So who we are, we've been investing in distressed real estate for the last 7 years across rural Colorado. We've owned multiple properties here in Gunnison. So we've been doing primarily real estate across the Western Slope. We started the Angel Syndicate back in 2017 when we officially launched 4 Points. And we started at the end of 2018 jumping into opportunity zones. There was a lot of hurry up and wait with the guidance that was coming out. We spoke at the very first conference back in June when we were all like, we're going to try to figure this out. Well, we figured it out to the degree that the regulations allow, and we are now up and running. And very fortunate to have a partner on board, Stephanie Copeland, who was at OEDIT back with Jana, and she was one of the ones that designated the zones across the state, and she's joined us as a partner at 4 Points. Couldn't go on with the slides here. I've got a couple slides on why rural Colorado. That's for the normal presentation. You guys understand why rural Colorado. Part of it does get back to the growth. The one thing I'll mention on this slide is that there's a projected net increase of, between now and 2050, the population's expected to double. There's a 1.7, 1.9, depends on the stats. But depending on the stats, it's almost going to double between 2015 and 2050, depending on your community. So there's a real influx of people. So housing and jobs are what this ultimately comes back to from a kind of incentive, what moves the needle in these communities. So most of our investments are looked at through that view. One more slide, please. And go on to one more slide. I'll skip the rest of why rural Colorado. On the left is some of the opportunity zone communities that we're looking at. On the right are the real estate investments that we've done across rural Colorado. Those numbers are the numbers of properties. So we're actively in these places. On to the next one, please. So strategy for us, again, I won't read each slide to you. Mostly the biggest driver for us is going to be housing. In terms of putting capital together to work at scale, most of that will go towards traditional multifamily housing. But we don't want it to only be that. We think there's some really interesting things across the state that we can invest in. I'll give you some specific examples in a second. A lot of it's also about absorption. If we were to build 200 units of multifamily in Gunnison that we launched tomorrow, there wouldn't be the ability to absorb that right away. It would push down the rental rates. It wouldn't actually be a helpful thing if we launched it in one day. What's that?
We could suck up, but maybe 2,000 we could.
Well, and so that's the timing, right? And so the timing of can we build it, and we'll get to this too, is what is the construction cost versus the rental rates in the community? Do the rental rates support that construction? So we're actively wanting to figure out how to build in some of these communities. It's good to hear you say that and push back, because that's great news. In some of the communities, in the smaller ones that we're investing in, we definitely couldn't do that. We've got an active opportunity zone project in Meeker, population 2,000. If we did 2,000 houses there, that would be a really bad thing. If we did hundreds in Grand Junction, that would be a good thing. So we want to balance the demand with the ability to absorb the investment, and that's a really key driver of our investment criteria. On to the next one, please. We're trying to do this at scale. We think that we can place certainly well north of $100 million in equity in the next 5 years, which is really the investment time frame for this incentive. The investment is all about long-term patient capital, but you're really only going to be doing the investment over the next few years, because that's when you get the deferral and the reduction benefits. Those go away the closer you get to 2026. As Jana mentioned, this is we're not investing to get a tax. We don't get any tax. Tax breaks or tax credits. It's all about the incentive on the federal taxes. You only do that through, I don't need a tax break on a project that loses money, right? I get that by losing money. We don't want to do that. This is market rate investing. We're targeting approximately a 12%. It's called an IRR, internal rate of return. Happy to talk through the numbers of that later if people have questions on it. That's a market rate return. Now that's a lot lower than we would see if we were a speculative developer building a house and selling a house. But this is long-term patient capital. So that's the return we're looking to pay to our investors at the fund level. And that's in line with what Janice talked about on the other funds. We think of the opportunity zone as really a spotlight. It's shining a light on these communities, allowing us to attract the capital to then go find the investments. And we're doing those at the same time. We're raising money and finding investments at the same time. So I'm going to go through a couple of slides about just really the real mechanics of what we're doing. If you could jump the slide, please. So this is just real nuts and bolts. So how it works at the fund level, and this is not really unique to us. The one thing that's unique to us is that we are doing a true multi-asset fund. If you were doing a fund just for one project, some of this might change a little bit. Prior to the April guidance, we could not have done a multi-asset fund. The timelines would not have worked for that. The only things that were going forward prior to April were single asset funds around real estate. We're doing real estate and place-based businesses in a multi-asset fund now that that guidance is available. So the way it works, if you're an investor, you invest into our fund. Our fund will invest in multiple QOZ investments. We're looking for stabilized assets. So we're looking, because of the long-term hold, we're looking for things that have a cash flow. In most cases, this will start after the development. Opportunity zone, it wasn't really mentioned earlier, but you can't go do passive investing. I can't just go buy a rental property. I need to go buy a property and substantially improve it. And so that's a new development or significant rehab if it's real estate, or it's moving things in or expanding if it's a business. The 10-year hold expectation, and then appropriate hurdle rate. Basically, that just means that there's a reasonable cash flow coming from these investments. So the fund structure, the multi-asset fund, goes as they talked about, the fund invests into what are called qualified opportunity zone businesses. Even at the real estate level, you still set up that lower tiered business that I believe Jeff talked about. Everything for us is real estate focused or a place-based business. So that, for instance, Sam's business, as we were talking to him, that's a place-based business. He's not going to jump up and move. If we're investing into a hot springs or a glamping site or a hospitality business, those can't leave, and that's one of the key requirements for us. You heard Josh talk about all the compliance issues. It's exciting to see a business move forward, But as we're raising money at scale, we've committed this fund to the businesses that could not leave the area. Those restrictions that get placed on the businesses work for certain businesses, and they don't for others. So for the fund itself, we're not using that on the business. And importantly, we are the equity fund, not the developer. What that means is we're looking to work with local sponsors, local developers. You don't want, out-of-state developers coming in and telling you what you need. It might be slightly out of the area development. If you're doing, multifamily, you might not have the crew just in Gunnison, but we're working with local sponsors, local developers that are putting these projects together. So we're really not out looking for a building to buy or land to buy. We're going to buy the land in conjunction with a project that makes sense for the community. The next one. So what we look for in the project: demand driver, the project ability to demonstrate long-term demand, a strong sponsor, the clear path forward. In a place like Gunnison, we feel pretty optimistic about that. The leaders want to see things happen. In a place like Boulder, not so much. So the clear path forward from a development perspective, good financial return, the ability to exit, to demonstrate the long-term value. So these are appreciating assets. The biggest benefit that Jeff talked about before is that after 10 years, the capital gains that come back to you are tax-free as an investor. So we're looking for things that are really going to have nice long-term value. One note on that is the income that's coming in along the way is not tax advantaged. So we're going to pay our normal taxes on the rents that are coming our way as that happens. And then we do use reasonable leverage. So these all involve some amount of debt as we go. I'm going to skip this. This is what we look for in a sponsor. So if you're a sponsor, please come talk to me. The community, I referenced it, the ability to absorb it, to remove roadblocks, and to have additional investment. Dennis made the joke, can we talk about other funds? We actually want there to be other funds. There's a new fund that's doing a partnership with Montrose on the business side, the Pearl Fund that just got announced yesterday. There's some other smaller individual funds. We're huge believers in rising tide lifting all boats here. So if we're investing in housing and someone else is investing in the restaurant next door and someone else is providing jobs, that's fantastic. So this really is a rising tide incentive the way we look at it. The challenges I thought are important to bring up. And the biggest one for us really is that 10-year hold period. It's great for attracting long-term capital. It's really hard to do real estate development when you have to do a substantial improvement and then hold it for 10 years. It's a challenge. It's a challenge to find projects that make sense because of the disparity between high construction costs and relatively low rents. In some communities, the only way to get that done is with community support, whether that's discounted land or tax abatements or whatever the right thing is for that community. Montrose in particular has gone a long ways in laying out those series of benefits, but they're really required just because of the high construction costs all across Colorado. And then I'm about out of time. The thing I'll leave you with is just an example of a couple of projects. So if you'll skip forward till you see prettier pictures. Couple of committed projects. So I'm going to pick the high end of the scale and the low end of the scale just to give you an example. So we have a property under contract right next to Las Colonias in Grand Junction. We're going to build 96 multifamily units. So this is relatively at scale project. We'll also build some glamping sites next to it since it's on the river. It's a $20 million type project. We expect the return to be in the 12% range, which is a nice attractive return, not hitting a home run, not astronomical, but a nice long-term return. And it has strong community support. This is not affordable housing in the federal technical sense. This is kind of the missing middle of housing. Nice new construction that can be rented out. Typical 1 and 2 and 3 bedroom type places. Actually, this one's mostly 1 and 2 bedroom, and it's that housing that you need for people that have solid jobs to live in your community. So that's a pretty standard one. This will be repeated. We're looking at multiple communities to do this. We'd like to do a very similar thing in Gunnison if we can get the landowner at the reasonable price. Not to look at the landowners, but so this is kind of the larger end of what we will generally do. We're not doing 20-story vertical development. That doesn't fit our communities, but we are doing 2- and 3-story wood construction, nice walk up, but new, modern, with attractive development. If you'll go 2 more slides. This is the other end of it. So this is Meeker, Colorado. This is a project that we should be up and running with in a couple of weeks. We're repurposing a failed RV park. We're building a tiny home hotel and also keeping it, the front end is an RV park. We're putting in a tiny home hotel. This particular one was on HGTV. So if you watch the shows, we've got a few of those. It's a smaller project. It's an $800,000 project. We're happy to play up and down that scale as a multi-asset fund. If we were an individual fund, it would be really hard to raise money to do projects this small, candidly. We've spent, I think, $60,000 in legal fees just getting things set up. You can't do $60,000 in legal fees and then do a, $600,000 or $800,000 project. But this is a place-based business. We'll own the business as the entity, and we will have employees. We will be operating it. Now, it is backed by real estate, but we are actively investing in businesses. So I wanted to provide kind of the scale of the things that we're seeing. We are a proper fund. There's some pluses and minuses to setting up your own fund. We're happy to share those. In some cases, it makes sense for people. In other cases, it does not. One thing I would say is we're looking at people that are investing. This is only around capital gains. A lot of people in the real estate business in particular do something called a 1031 exchange, where they sell an asset and then they roll all of that money forward into another larger asset, and they just keep doing that. And we call it the 1031 hamster wheel. Well, the way you get off that hamster wheel is you die, and then you get the nice tax advantage for your asset planning, I guess. What this does is, for those people that have gains now, it allows them to separate out their initial investment from their capital gains. So if you have that same asset and you sell it, you only roll your gains forward. You put your gains in the fund, and then you take your principal and do whatever you want with it. And that ability to separate that out is a really unique thing about this tax incentive. And it provides a lot of freedom and flexibility as long as you've placed it within 180 days. I don't think that time frame particularly got talked about earlier, but you as an investor have 180 days from when you realize your gain to place it into the fund. And then the fund has a time frame of when we're going to invest it into the assets. We can't land bank. We have to put it into some type of active investment. And we have our own time frames. I won't get into all those, although I think any of us can answer questions around that. But it's really driven by the investor's time frame. The important part is your 180-day time frame, either from when you sold the asset or from the end of your partnership year, if you did that as a partner. That time frame drives everything. So on our side, we are setting up a series of funds. We have Fund 1 open just through the end of the year, and then we'll launch Fund 2 for next year. You don't want to invest into our fund and have us raise money for 4 years and it turns into a 15-year hold for you. So we actually are setting up a series of multi-asset funds to mesh with the investor's time frame that also has to mesh. One of the biggest challenges is matching the size of the capital we have with the size of the project and making those the timing of that worked out. So that's it for my presentation. We're happy to share that. There's a bunch more slides, obviously, but just wanted to try to stick in the time frames, and excited to be on the panel with the rest of these guys. I don't think they're all going to need these chairs, though, so I'll just take one of them.
We don't have any questions online. That seems impossible with the way that people comment online these days. They have no questions. I guess I'll look over here. I'm completely disappointed in all of you people that are watching right now. So do we have any questions in the audience here about everything that just got presented to you? There's got to at least be, yep. We're going to go here first.
This is directed to Jeff.
Hold on one second.
This is directed to Jeff and to talk about more about the timing. You did that at the end. If you're looking at your investor coming in, what are the criteria that he needs to worry about? Getting that 180 days, and particularly in real estate, being able to roll that over.
Sure. So there's a number of timing days, and I'll stay as much out of the gibberish as I can. But so the qualification is that you have to invest gains from the sale of any property. It doesn't have to be real estate. It can be any property, Bitcoin, wedding rings, whatever. It has to be to an unrelated party, so you can't sell something to your dad to create the gains. And we actually do get into a very complicated issues related to that. And it has to be invested within certain time frames. The main time frame is it has to be invested into an opportunity fund within 180 days from the date of the sale. That's for general property. And it has to be, as we've heard, capital gain. If you are in real estate and you are part of a joint venture and let's say your joint venture, which is a partnership, it sells the real estate, then you have two shots to invest. Either you or your partnership can invest into an opportunity fund in the 180 days from the date of the sale, or you personally can invest your portion of the gains in the 180 days starting the last day of the tax year, mostly December 31st. Now, there are two other things to say, which I'll say quickly. There is a certain type of gain, which actually I described, which is mostly the sale of real or depreciable property used in a trade or business, meaning rental real estate. That is what we call Section 1231 property. That's one of my two allowances, to use a code section, that they gave me. Because of the way Section 1231 property is dealt with, it actually has some good benefits. Gains from those sorts of gains, actually, whether it's through a partnership or you personally, they can only be invested in the 180 days starting the last day of the tax year. So if you're part of a real estate investment and you sell the property, say February 1st of 2020, and your accountant says, well, this is a 1231 gain, and assuming that that is the amount of 1231 gains you have for the year, it's the only one, then you got to sit on it until December 31st, and regardless. And so you have to make sure that you know what kind of gain is and deal with the timings. And that leads to one other really fun point. Recall that you get this discount from the tax. If you invest capital gains in an opportunity fund, you are going to pay tax on that gain recognized in 2026. And if you hold it long enough, you get a discount. So the deadline for getting the biggest discount is this December 31st. So we have, at least in our office, a very large chunk of these Section 1231 gains that in theory could be invested December 31st through June 27th of 2020, but virtually all of them are getting invested in the opportunity funds December 31st, 2019. So luckily that is not on the weekend. So that's the basics of the investment timing. I'm sure there's more that can be said, but that's what I have on that right now.
Okay, so before I take a question from the audience, I'm going to take one from the online audience. Michael asked, what do I need to do as a business owner to establish myself as a qualified opportunity zone business? And is there a specific structure required, i.e. LLC, C Corp, etc.?
I'm happy to take if somebody else, I think we all have this. So a qualified opportunity zone business can be a corporation, an S corporation, a partnership, or an LLC taxed as a partnership. The key is that it has to be what we call a regarded entity, meaning it cannot be a single member LLC. And if you're doing your own, we can arrange that so that it works. So again, if you're doing it as an LLC or a partnership, the opportunity fund, if you only have one, cannot be the only member. There are also qualifications, which are in everybody's slide deck. About 70% of the property owned by this QOZB has to be qualified opportunity zone property. It has to conduct a trade or business in an opportunity zone, and there are tests for that. And there's also a couple of more. I'm happy to go farther into the weeds, but Chris, maybe what issues have you dealt with in dealing with making sure you've got a qualified opportunity zone business, and for Josh too?
Yeah, I think you've covered the most of it. The thing I would say is that setting things up is really actually very simple. There's both at the fund level and the business level, very simple to set them up. It's the compliance piece of it on both the real estate and the business side that's important. So setting up a fund is a one-page piece of paper that you fill out as long as you're, a partnership or a corporation or a partnership. Really the same thing on the business side of it. The devil is in the details on the compliance piece, and so that's where having somebody that can guide you through that is really important. I know that's a little bit of a cop-out answer, but it's very important. The qualifications on the business side are pretty clearly spelled out. They sound really clearly spelled out in terms of 50% of your management and 50% of your staff. But the answer of what really fits is, I was talking to Jim earlier, and it is very deal by deal to make sure that it fits. It's very easy if you're running, hey, I'm gonna do a pizza restaurant next door. 100% of my staff are here. But if you're doing a proximity space, for instance, Josh talked about some of those risks. It's really the compliance risks around staying compliant, that you don't grow outside the zone, that you don't move. The setup piece is actually very straightforward. Attracting capital is a different question, of course, but the setup has very little challenge to it. It's really the compliance and staying in the zone and within compliance.
Yeah, I think can I jump in and add to that too? I think, Chris, you're absolutely right. And the whole idea of the devil at the details, some of this is also looking forward, especially if you're just getting started thinking about this, looking forward to what is my company going to look like in 10 years? And how do I not only have it compliant now, but how do I keep it compliant in kind of all manners of your model? Or can you keep that compliant? For us, one thing that I like to remind everybody is it's not necessarily keep it compliant within that zone, it's within zones. So companies like Proximity, when we have job networks attached to our system, we can actually reach into zones throughout the country and hire throughout other zones. So we don't just have to stay in Montrose or Grand Junction. We can start hiring in other parts of the state or other parts of the country, so long as, one, you're keeping track of that level of what's in and out of a zone, as well as you have, in my mind, a preference towards hiring within zones to kind of keep that compliance, because it can go multi-zone. It doesn't have to stay in the same one. But it is definitely something to consider.
To add to that, that's a specific example is we've talked to a company. There's a company, they're actually based in Aspen, but they're planning to build out their logistics facility in potentially Grand Junction. So we're having an active conversation. The majority of their workforce will be in a zone where their headquarters don't happen to be in the zone, but the majority of their tangible assets will be. So it's a specific Colorado example of exactly that thing. We're talking to them, even though we don't invest in the business, about potentially investing in the facility to support the business that'll be placed in that zone. So there's a bunch of different ways to structure the investment, both the legal entity as well as just how you skin the cat, essentially.
So before I grab, we had 2 or 3, right? So you were next, and I'll kind of try to keep you guys in order. Reminder real quick online, if you are interested in answering or asking a question, the Q&A button at the bottom of the screen, click on that. You can ask your question, and David will share it with us. So I'm going to hand this off to you.
Thank you. For anybody, you're assume it's multi-asset fund above you, but you have a smaller project that, let's say in 3 to 5 years is totally complete, but your overall investment fund is trying to get the full 10 years. Are you able to, in essence, sell that, hold the capital gains in the fund, and then have another project fill that out, or not, or do you know?
Jeff or Chris, who wants to go first if both of you want to get involved? So Chris is going to.
You know this stuff.
Okay, Chris goes
interim
first.
gain issue, it's called.
So I am not a tax attorney. I just feel like one and spend too much money with them. But so there's really 2 parts to that answer. So the interim gains issue, we thought that was 50-50 going in. We were hopeful that they would give us the ability to do exactly that. It would actually be great public policy if we could do that investment, sell the investment, keep the money in the fund, and just roll it into another investment and do that. So they did not give us any interim gains relief, meaning that if I were to do that as a fund, we build something, we then sell that off. That is a taxable event, and that'll flow through to our investors. Now we can keep. They did clarify that we have a year to reinvest that money, and we can keep it in the fund. But it does some challenging things to your holding and timing periods. You've also created capital gains. There's some questions about, do you then want to maybe 1031 that money? It gets complicated. So from a fund perspective, and Jeff can add to the legal piece of it, but from a fund perspective, what we've decided to do is that we're going to only invest in things right now that we intend to hold for 10 years. Now we could be wrong. We could have a bad asset that we need to sell off. We're not worried about gains. We want to rebalance and reinvest. Or we could have such a great deal that, you know what, it'd be great to avoid taxes in 6 years, but this is so much money now, it's better for our LPs to go ahead and sell it and pay the taxes. So there's flexibility that doesn't keep you from doing that. But practically from a fund basis, we're only investing in things that we intend to keep for 10 years. Now our development partner might need to have their gains paid out. We can pay the development fee. You can do crystallized artificial waterfall schedules. There's a bunch of things you can do around that. But from a fund perspective, we intend to hold the whole time.
Jeff, anything you'd like to add?
Yeah, just one thing. Obviously, that's exactly right. We have dealt with some of our clients that do want the opportunity to roll over, and what they have given themselves the option to do is to, you're absolutely right, if there's a sale of an asset or of something, it's going to be a capital gain. If that happens early enough, meaning basically before 2026 or so, those gains can actually be reinvested either into the same opportunity fund, which is not really such a great idea, or into a new fund. And now there won't be much tax deferral because that capital gain that's invested, as we've said, does get taxed, but it does give the opportunity for the big fund, you know, if that second investment is a good investment and is held for 10 years. So we've done that for some folks, and others just decided if they have to sell and they have another good investment, everybody will just pay the tax and they'll reinvest the money.
So just for layman's terms, real quick too, Jeff or Chris, that's essentially resetting the clock though, right? For the 10-year investment?
Yes, but sort of in part, really. Essentially it does, because that new investment, if it goes back into the same fund, those folks for that portion have to hold for 10 years. If you sell after the first funds have come in and been in for 10 years, but before the second ones have been held for 10 years, sort of in that little donut hole, then there's sort of a apportionment of what percentage gets the complete tax avoidance, and the other one will pay tax. But nobody's going to want to do that. So basically, you're right. That was a way too long way to say, yeah, it's going to extend the fund life.
New question.
Jana Russ-Forrest with the City of Gunnison, and you're prompting the question, but it's a question to the panel, and particularly Chris, you probably have a perspective on this, but you mentioned it's scary to invest in the rural West beyond Boulder and Denver. And we've heard that from investors that want to place $10, $20 million in a safe investment and get 12 to 14% return. But what are you seeing on the West Slope that's been successful in terms of connecting investors and entrepreneurs and developers?
Yeah, Chris, feel free to jump in, about some of the work that Western Slope Angels or Techstars or some of the groups that have done. I'll speak from the community perspective. I think there's a gap to be filled by communities in terms of de-risking and these investments and potentially adding to the returns. And so we've seen some pretty effective partnerships out on the Eastern Plains. Fort Morgan really needed some workforce housing. And so the city owned a plot of land, and they more or less donated that plot of land to the developer so that the developer could build that housing on it. The actual cost to the city, not that high, but it really brings down the developer's costs and makes, kind of that construction cost rent match that Chris was talking about work better. Montrose has done a really good job of pairing its urban renewal authority, its enterprise zone, and its opportunity zone, and creating a really, friendly environment there, as well as cutting a lot of the red tape. As we're talking about some of these timing concerns, one of the things that can really put investors off is that if they're worried that they're not going to be able to meet the timelines, there is a safe harbor for government delays, but just even outside of the opportunity zone incentive, having your project stuck in permitting and zoning and things like that for, months on end can really delay the project. So I think it's about thinking about what's the right mix of either incentives or other offerings that the community can add to make those projects just jump a little bit above the Denver projects, while still balancing the cost benefit to the community and making sure that it's still benefiting the residents.
Yeah, and so on the investor side, that's probably the biggest challenge. Our goal in the mission statement, right, is to build the path to invest at scale in these emerging communities. We've had several people that we were talking to that were very interested, but they've all got choices, right? Downtown Portland is an opportunity zone. Most of Harlem is. Downtown Houston, those are established places. So, investors think that Kansas City is rural, and that's already a secondary or tertiary market. Small towns in rural Colorado, it's challenging. Our goal is to kind of remove that friction, and that's part of the always having a fund available, having multiple assets so we can do traditional things that might have a lower 12% return. In our case, we're trying to roll in some of the smaller projects that are opportunistic but hopefully a higher return. But part of it is building momentum and just honestly proving this. If we get some people from Gunnison to invest in our fund that is investing hopefully here and in Montrose and proving that this part of rural Colorado, it's got some amazing natural resources, the beauty, it's got actually a lot of intellectual and financial capital, but unlocking that and having people be willing to jump in and invest, it's a real challenge. Hopefully we're all up for it, but there's no magic bullet. There's no magic bullet for that. Proving that you can invest at scale is one of the bigger challenges. The OZ, like I said, has shined that spotlight on these communities, and it's up to all of us to then attract that capital, because it's a massive tax benefit. It's somewhere between 35 to 43% on most of the projects that we've looked at. That's enough to really incentivize people if we can find projects that truly make sense. So a lot of it's project and community driven.
So I know that we have a couple more questions. I wanted to check on time. Are we still good? So.
Yeah, 10 till 7, and we can stay till 7.
Okay. So.
Yeah, things might start getting a little louder around 7.
Okay.
There may be an event downstairs.
So it doesn't look like we've lost people offline there. And again, if you have questions, let us know. But we've got another question here. So still the same. Yep. Okay.
This can be a question for anyone, but just to understand it more from, I guess, a real estate and development standpoint, it seems simple as far as setting up the fund, and you have 180 days, I guess, to put that money from an investor into that fund. The part that I guess I'd like a little bit more explanation on is, once you have that money in the fund, it can be there to purchase property. That property could also be developed. And how does the rolling clock work on all of that? Is it from when the property is purchased, or is it from when the build out ends? And can the funds be used for, the development as far as buildings and whatnot too, or does it just apply to the land? So.
I know Janet, both you and Jeff could probably jump in there. So who wants to go first? Jeff?
I was going to suggest Jana, but
Jana, you want to go?
Sure. And so the question was around just to make sure I understood it, because it was a little bit hard to hear. The question was around the substantial improvement and where funds can go after the property is purchased. Is that correct?
A little closer.
Yeah, the timing as well. I mean, it is also, can the money be spent on building, but then the timing of it too. When does the kind of rolling clock for the 10 years start?
Yeah, so Jeff can jump in on the technical pieces, but my understanding is that the clock on the fund starts as soon as the fund is established and capital is put into it. And that's actually where the 10-year hold comes from. And then once actual property is purchased, in order for that property to remain qualified opportunity zone property, and therefore the fund to remain in compliance, the property must be substantially improved within 31 months, which means doubling the value of the property on top of the land. So you get to exclude the land value from that calculation. And Josh or Jeff or Chris, you can talk a little bit about what that substantial improvement piece looks like for business investment, because I know it's a little bit less clear.
Jenna,
Does that answer the question?
hold on 1 second though. I think so, but I feel like there's one part that got missed because you only said building on land, but you can also purchase an existing building, and there are qualifications or compliance that have to be around purchasing a building as well.
Yeah, there's two. If you purchase property, there's two things. It either has to be original use, which means the first use of the property within the zone, or it needs to be substantially improved. Substantially improved means you have to double the value of the property. You have to spend as much improving the property. So if you bought a property for $1 million and the land value of that was $300,000 and the building on top of it was valued at $700,000, then you have to spend an additional $700,000 basically improving that property. Vacant land is a little bit of a gray area because, there's no set benchmark, but my understanding, and others can correct me if I'm wrong, is that as long as you're essentially meeting the anti-abuse provisions and actually building a substantive structure and operating a trade or business, you're probably fine. You can't buy a large piece of land, put a lemonade stand on it, and then land bank it to meet the requirement.
There's a lot of disappointed. I think there might be a lot of disappointed people in here now. All of a sudden,
who thought they were building a lemonade stand?
Jeff, did you or Chris? I think Chris wants to add on it. Jeff, did you have anything you wanted to add while I walk to Chris?
Maybe just one or two things. The 10-year gain is at the investor level. So what it means is that the investor has to have his money invested in the fund for 10 years. So investor A comes in February 2nd. 10 years from then, investor B comes in March 1st. If there's another closing, 10 years starts on that date. And then there's you have to go from there. And I think Chris was going to speak on that side.
Yeah, so from a practical perspective, from the fund perspective, the way we look at it is actually 3 separate clocks. I think that's the simplest way to look at it. You've got the investor's clock, you've got the fund's clock, and you've got the project level clock. So the investor piece is really simple. Well, there's the 3 scenarios that Jeff outlined, but ultimately put your money into the fund within your 180-day period. The investors met their criteria. So that piece is pretty simple. It's driven by the investor. The fund then actually, there's a little bit more nuance. Everything Janice said was right, but there's an intermediary piece with some nuance to it, in that the fund, the reason we're now able to do a multi-asset fund is that they gave us a little bit of a grace period. So we as a fund now have our own time frame. We have these testing dates every 6 months. So we'll have a testing date on December 31st. At the fund level, we're actually able to ignore the money mostly, but we're able to ignore the money that we've raised in the last 6 months on the first testing date. So if you invested with me today, on December 31st, I've got a testing date. I get to ignore the money I've just now raised, but by the next testing date, which means June, I now have to have that money either invested or a plan of how I'm going to invest that money. And then that 31-month or 30-month period that Jana talked about kicks off. So there's actually a little bit of flexibility at the fund level, and that project level is where you have that, at that lower tiered entity project level is where you have the 30 months. So practically speaking, if you're investing now, we've got to be locking up the deals now, planning for those deals, because I have to have that money invested and placed with a plan for improvement by the end of June on my second testing date. So there's really 3 clocks, and there's some more nuance in that I won't get too tax wonky with, but there's kind of 3 clocks that go on there. And I'm happy afterwards to really to dive in deeper and just sit down and talk about the specific projects if you like.
Josh, I didn't know was there something that you wanted to add in on that as well?
No, these guys I definitely don't want to try to add on to really good answers. I can only go wrong at that point. So,
well, though, Josh, you have the one that has experienced testing dates in an operating business, and that's something not many people have seen.
Yeah, no, I mean, testing dates are fun. Yes. But I think ultimately, Chris actually put it really, the way I look at it is each dollar has its own clock against it, and it's driven by that investor side. So all I ever talk to is investor side of it, and it's really that it is triggered against their horizons. This is an investor benefit, and as long as you keep track of those funds and the dollars and when they were put to work and who put them to work, that's kind of the nuances for the funds to deal with that. It really is taking it to a level of accountability to the specific investor versus just looking at it at the fund level. But all of the established funds right now really have gotten good at this part. So like I said, I don't really have anything to answer. They do a great job.
Any other questions here from the audience? Anybody? One over here. There we go.
So one question I have is kind of around the piece of, you cannot be a related party. And so let's say you're working with someone and they happen to own a piece of land and they're willing to sell you the land for a project. Can they take the gains from that sale and invest them into an OZ fund to put back into that project on the land they sold?
I'll grab this one. The answer is yes, provided that they don't have more than 20% of the project. Some people think that so long as they're not related parties when the land is purchased, that's good enough, and then they can come in. I'm not too comfortable with that. But we do have solutions if let's say the landowner, he wants 40% of the project, or a developer owns property and gets a promote at the back, that's 30%. Because the related party rule is you can't own more than 20% of the capital or profits interest. And, for the last 100 years, people have been trying to figure out exactly what a profits interest is and how much you have. So just to be safe, we have a lot of techniques. The main one, which came out of the regs, is that if the landowner is going to, we think, have too much of the development, the landowner can ground lease the land to the opportunity zone business, and then after the project is built, then the project can either just buy the land or the land can be contributed sort of on the back end, and that won't threaten the structure. That's again a little bit in the weeds, and I'm sorry about the back end part, but we do have ways if a landowner or a property owner really wants a bigger piece of the project.
Got another question?
You've used, I believe, about 12 to 15% in the initial investment return, but obviously there's overheads for the company, overheads for the fund, which will that cut? I guess what's sort of acceptable overhead cost have you got? Because you mentioned $60,000 in legal fees. Obviously, you've got compliance fees with reporting, keeping track of the investor money. I mean, essentially, you're running a very strange mutual fund at that point. But what sort of percentage cut does that go into the 12% return?
Yeah, great question. So in our case, the ones that we were modeling up there, we're modeling that as that's the gross return back to our LPs prior to calculating in the OZ benefits. So that's after our fund fees are built in. So on a project level, we're actually targeting more in the 15 to 16% IRR range. And I've got a sheet on the deck that I'm happy to send to you that makes our fees very explicit. We've got an assets under management fee and then a back end carry on the fund. We pay we accrue an 8 pref. So if we make 8% on the deals, we're not making any money. So that's kind of where that 12 comes in. We're really targeting more like 15% on the project level, but happy to share the specific details of that. But we want it to be apples to apples, because if you're investing in that project outside the opportunity zone, IRR is generally based on that cash flow back to the investor. So most private equity real estate companies are going to be talking about it the same way. That's the amount you as an investor, no guarantees, of course, it's at risk, but that's the investor return that we're targeting. But that's before factoring in the tax benefits. And really that's because everybody's tax situation is unique. So there's more. I can get more into the specifics of that, but that's the return that we're with the fees already taken out of it. There are significant compliance fees, as you've mentioned, third-party administrators, et cetera.
Any more questions? Any role-playing scenarios that you want to know? Like this, we can't do a lemonade stand, no tanning booths, but anything else? No golf courses, unfortunately. No questions? Anybody? Come on now. Somebody's got one more.
Dennis, I could add something while you're walking over there. Can I say something real quick?
Sure.
So one thing I've been getting in the habit of during these talks, especially when you're in rural communities when they're being given, it's different when you're sitting downtown Denver at one of these, is that I think there's an interesting opportunity for communities, especially for those that either own a lot of property or have done really well and live in those communities, that it's a really interesting opportunity to invest back into your communities, into projects that are going to take place within those zones, within your rural areas, and be able to kind of keep those gains in play in your area. And I think that watching and talking to some of these funds that allow somewhat of investor preference as far as like what is it that they're working on, what are they getting excited, but if the individual investor doesn't want to take on the liability of setting up their own fund, as a single entity, going in and talking to some of these groups like 4 Points about like, here's projects we really like, but I don't want to take on these compliance issues. I don't want to take on this, but I want to give a spotlight to projects that are happening in my community. I think it's been quite successful. And growing up in this area, I definitely have watched there's tremendous resources, especially financial resources in our communities. And this is a really neat way to keep those companies and projects going in your communities by accessing opportunities on funds. So just always want to throw that out that these small communities have a lot of resources. So there's my time filled for you, Dennis.
Just to understand the numbers a little bit more, I'm going to throw out a couple examples. So let's say you were going to do a real estate development and you spent $100,000 on a piece of land. You put another $300,000 from the investors fund into it, and you go to the bank and you get another $300,000, and you have this project that's built out. Would that work out okay as far as like substantially improving the property? And same with if you're purchasing a building and maybe you brought in some loan money as well as investor money, and how that might work.
Jeff or Jana, who wants to? Because I didn't see Chris jump for.
I can start. So there's the first point is that if you are buying unimproved land to put a project on, whatever you build on there in an opportunity zone is going to qualify, because new construction will meet this test that the original use of the property will commence with you. So you don't really have to worry so much. Where the substantial improvement comes in is on value add projects in real estate. And you can use debt and equity to fund the improvement. It's just if you buy land with a building on it for $300,000, as Jana said, and the land's worth $100,000, you need to put in $200,001 to meet that substantial improvement test. How you fund it is not really a factor.
Misnomer that all of the improvement has to come. I get asked this all the time. They think, oh, if you're putting in this much opportunity zone money, that has to match the improvement. It doesn't actually say that. What it says is that you have to do the substantial improvement, whether that's through partial opportunity zone money, some non-opportunity zone money that's also invested through debt, through grants. The improvement just has to happen. So there's actually more flexibility on that piece as long as it's substantial enough to do that 1x improvement. There's quite a bit of flexibility to do normal real estate business. You might fund it in a variety of ways. That piece is okay. The only real restriction is that you can't do something with cash to start with that's through the fund and then try to refinance it within less than 2 years. If you're trying to pull capital back out, it can look like a disguised sale. So you have to be careful on the compliance side. But there's actually a lot of flexibility about how to fund and structure these deals.
So we do have a question online as well, and I think Jana, just for some clarification on this, we talked about the sin businesses, and liquor sales are part of one of those sin businesses, but what about a distillery?
Yeah, so this is another kind of gray area, and what I heard, someone asked this question at one of our previous events, and what someone said is that it's about liquor being sold off premises, and the number that they gave, don't quote me on this, Jeff, jump in, is that basically if more than 20% of your business is centered around selling liquor to be consumed off premises, then you count as a liquor store. But if less than 20%, if primarily your business is, people coming in for tastings and things like that, then you're probably okay.
Yeah, I think that's the general consensus. There is a push to say that, so long as it's not sold at retail, you can be okay. But I think people are being careful. One thing though, this is the, I don't know what, the tax lawyer doing the tax thing. Technically, only qualified opportunity zone businesses are prevented from doing sin businesses. If the fund itself has the business, technically a fund can have a golf course. Now, they'd never qualify for other reasons, but it's just a quirk in the law that maybe, I guess, you have to be a tax lawyer to enjoy it, but it is a technical quirk in the law that the prohibitions only are on QOZBs that have these businesses.
That is a good point, though, Chris, and maybe you'd be happy to speak about this. The fund doesn't have to have 100% of its investments be opportunity zone investments, even if it's an opportunity zone fund, correct?
Yeah, technically. So to quote Jeff, so the fund has to have 90% of its investments be qualified opportunity zone investments. Usually that's at the QOZB level. The individual investment underneath it, so the fund invests into the QOZB. On the testing dates, the QOZB has to be 70% invested. So for most people, most funds, most projects are doing 100% of their investing in the zone, and they use that cushion as a safeguard. But strategically, there's actually some funds that are, hey, I'll go do this 70% investment, and I'm going to take 29% of that money and just intentionally and strategically invest outside of it. You have to be careful with it. So our main responsibility is back to the fiduciary duty back to our investors. We don't want to be anywhere near the guardrails on something. Having said that, one of our entities has done a couple of projects. We've got an entity that's done an $800,000 investment in Meeker and a $400,000 investment in Craig. So we got about a $1.2 million investment. That means we've got a few $100,000 we can invest completely outside the zone in that entity. We've actually done some of that. We just purchased a property that we're rehabbing and renting in Rangeley. So we've intentionally put some of our investment. We're not going to be anywhere near that 30% guideline because you got to be careful. There's more to it than that. But strategically, you can do some investing outside the zone if you want to. That buffer's there really for practical reasons, especially on the business. Real estate, you have to be really careful. On the business side, there's some additional guidelines as well. But yeah, you can be strategic about that.
Jeff, did you want to add in on that at all?
No, I think that hit it exactly. I think, well, it might apply more to Josh's entity because, they can have a small number of facilities and things outside the OZ, and it'll probably be okay if they need to.
Yeah, I mean, that just comes around to staying away from the guardrails, that there is still going to be this capability of flexibility, but it does change the rules, and you do want to stay, like Chris said, away from the guardrails. So there'll be little bits here and there that are expected and kind of in balance with how the company's growth is. So as the company continues to grow and that 70% becomes a larger number against the 30, you'll see us make those moves, but it really is, you have to consider that this is now an opportunity zone business. And everything else is just little movements. So,
all right. Well, we're peeling off here. We're slowly and surely losing an audience. So, is there any other questions that anybody had? What is it? Speak now or forever hold your peace. Anybody? Anything left from the audience online? No. All right. I want to thank Josh. I want to thank Jana. I want to thank Chris and Jeff. And I want to thank the ICELab. Thank you very much. And a reminder as well, as Jenna mentioned, there is a pitch event coming up. So if you want to have even more information, you want to see what kind of companies are trying to establish themselves as OZB, I would encourage you to check that out. I would encourage you to reach out and take a look at 4 Points Funding. And Chris is an amazingly inspiring person to talk to, so I've enjoyed our conversations, Chris. Josh, you can talk to Josh anytime you want. I'll give you his personal cell phone number if you'd like. And Jeff and Jana, thank you as well. I really appreciate the work that you guys have done. And Jeff, thank you for taking the time. I know it's late out there in Denver too. So
Chicago. Jeff's in Chicago.
Jeff's in Chicago, so it's even later. My bad. Good man. Thank you, Jeff.
Well, let me just say it is really a lot of fun dealing with all these folks. And hearing folks like Chris, not only him, but lots of other folks who are starting funds and doing things, the incubators, is really a fun place to be working in.
I want to thank the ICELab for having us and putting this on. Thank you very much for taking the time to organize it. All right.
Thanks, everyone.
Thank you, guys.
Thank you. Everybody go. And I will, if we have a lot of email addresses, so if anybody wants slides, we'll send out an email tomorrow with the slide decks and contacts for all of the panelists and ours. And please reach out if you want to dive deeper. Yeah, and thank you. David, do you want to say anything? No, you're good. Yeah, thank you. Appreciate it.